So in today's video, I'm going to do my best job possible to paint a picture for you of what a scaled portfolio can look like, and then push you to think about how you can get there faster than you were probably thinking was possible before you watch this video. Hey, I'm David Green, host of the Bigger Pockets Real Estate Podcast, real estate book author, real estate broker, sales team leader, mortgage loan officer, real estate nerd. And in today's video, I'm going to give you part 5 of the series of why I love real estate, scaling. Man, so what is scaling? Let's start off right there. Scaling is the idea of going bigger, faster, and farther. It's the idea of taking something that you know how to do well and doing it more times than one. It's growing something bigger without taking on exponentially more work through the process of systems, procedures, and experience. Friend investor girl Britt originally built her Instagram profile by showing videos of herself fixing up properties. And she got stuck in a place where she was thinking this is all she was ever going to do. Now Britt helps to raise money to invest in other people's deals. And one of the things that she realized is that she wished that she had been thinking bigger sooner. So let's talk about scaling from my own personal perspective. I started off buying one rental property a year from the years 2009 to 2013. And the reason I did that was I thought it was safe. During that time, the market was not hot. Prices were not going up. If anything, they were kind of creeping down low. Rents were not going up as fast as what they are right now. And when you turned on the news, what you heard everybody saying was the market's going to crash. Real estate is done. It's never going to recover. Home prices aren't going up.
The National Association of Realtors reported the worst month-to-month drop in existing home sales since they started keeping track in the late 90s.
So for some context, I bought my first house in 2009 for $195,000 in Lathrop, California. It had sold in 2006 for $565,000 3 years earlier. This house was 3 years old and it dropped from 565 to 195. After I bought it, it went a little bit further down into maybe the 180 range. And I actually thought I made a mistake and bought too early. But my point is, everywhere you went, people were saying the same thing. Don't buy real estate. This is a terrible market. Now, with hindsight, when we look back, this was the best market that could have ever existed. We all wish that we had bought more real estate, but it didn't feel that way at the time. And for that reason, because I didn't trust myself and I listened to other people too much, I did not scale. I bought one house in 2009, one in 2010, one in 2011, one in 2012. And in 2013, the market took off in California so fast that I could not buy real estate here anymore. It quickly got to the point where cash flowing properties did not exist. The price of the houses was just too high. And I spent my next couple years doing nothing until I decided I was going to go invest in Arizona, which was my first venture into long distance real estate investing, which eventually became a book. Now, I bought 2 properties in Arizona, and then I waited until next year, and then I bought another one, and I kind of moved into where I was buying about 2 properties a year at that point. So I had doubled what I was doing, but it still wasn't anything major. It wasn't until I found a bank in Florida that would give me a line of credit and an agreement to buy properties and then refinance that I really started to scale. And that's when I learned the BRRRR method. It's when I went out to Northern Florida and I started finding fixer-upper properties, buying them, fixing them up, and then refinancing them through that line of credit that I really scaled my portfolio, where I started buying 2 houses a month. And that was where I became a really good investor, and I learned how to manage crews, and I learned how to analyze deals quickly, and I learned what worked and what didn't work. And it really formed kind of the foundation for the investment advice that I give people now. But if I went back and you said, David, what would you change? I would have said, I should have scaled quicker. I knew what I was doing. I was just scared. So in today's video, we're going to talk about how you can scale quickly, how you can scale safely, and what stops people from wanting to scale. So let's talk about how you can scale quickly. I've got this analogy that I always like to use, and people are trying to figure out how soon should I go really fast. Now, I want to take you back to my police academy days. This was around 2006 or so. I'm a new recruit in the police academy, scared every day that they're going to kick me out of this thing, because if you failed anything, you were in danger of getting kicked out. Maybe half the people that start this class that have already been pre-vetted actually finish it. So we're driving around this racetrack that is set up to teach us how to handle our cars. And they've got cones put out on an airport runway. And they tell us that these cones represent people. So if you hit one cone, that's like hitting and killing a pedestrian. You cannot hit even one cone. And then they say, Now you have to finish the course in this amount of time, which was very difficult to do. So you have to drive simultaneously, safely and quickly, which is why they created the course. And as you can see, there's some connections here to scaling as a real estate agent. Now, some of the recruits in my class drove as fast as they could right off the bat and hit a ton of cones. Other recruits went really, really slow, so they never hit a cone, but they never finished the course on time. None of us really figured out how we were supposed to handle this thing. And after several days of driving the course, it started to click. I would start off going slow. I didn't want to hit a cone. And at a certain point in my driving, my brain would tell me the sharp turn's about to come up. You better brake early. Or, hey, there's a left turn. As you come out of this one, there's going to be a right turn. So you have to make sure that when you hit this point of the left turn, you're already turning the steering wheel to the right. I started to anticipate what could go wrong and what needed to come next. And at the point where my brain started to warn me ahead of time, hey, this could go wrong, you need to put something in place to make sure that doesn't happen, that's when I would drive faster. When I knew what was coming, I could push the car to its limits and myself to its limits, and I would stay at that new speed until I started to anticipate even more, even quicker. What I learned is that's the way to scale. You start off slow as you learn the course. You want to learn every single turn and know when it's coming. Then you want to learn the car. You want to learn when you hit the gas, how long does it take before it accelerates? How quickly does it brake? How fast can you turn from left to right without losing traction on your tires? When both of those things come together, you're ready to scale. And now that's how I build companies. It's how I build businesses. It's how I build my portfolio. I drive slow to not make mistakes. I don't want to make mistakes. I don't want to lose clients' money. I don't want to lose my own money. As I start to anticipate what could go wrong in my next deal or with my next property or with the next client or with the next employee, I slowly go a little bit faster. When I start to anticipate the next round of mistakes, I start to go a little bit faster. When I feel like I know exactly what could go wrong, it's like you're driving with your eyes closed. I pin it, pedal to the metal, and I go as hard as I can. So when it comes to scaling quickly, the fastest way to do that is to learn as much as you can safely. It's not enough to just buy a house and let somebody else work out all the details. You've got to understand why that deal worked or why it didn't work and what worked about it. I highly recommend you doing more of the work up front, or at least asking the person who is doing the work to explain to you what they're doing until you understand it. You've got to learn the course. Now, some people make the mistake of scaling too fast and they end up running over cones. This looks like running out of money on their rehab, not anticipating that the city was getting involved and shut down their permit process, thinking that they were going to get more for rents than they did. There's a lot of things that can go wrong if you try to go too fast, but other people also go too slow. All right, so that's my advice on how quickly you should be scaling and how to maximize getting the most out of yourself. You want to scale sooner whenever possible. You just want to do it safely. And when it comes to doing it safely, that's what we're going to talk about right now. Now, I've got a theory when it comes to doing things safely. You don't want to do everything the same. And what I mean when I say that is that when you look at your portfolio, you want certain elements of it that balance out other elements. So imagine that you're a UFC fighter. Every once in a while, you might swing for a knockout punch, but if every single time you throw a punch, you're trying to knock out your opponent, you will be off balance, you will miss, and they will actually be able to hit you. So it's not safe to throw wild uppercuts every single punch. You want to mix them in with jabs or maybe with takedowns, something to keep the opponent guessing what you're going to be doing. Well, in your own portfolio, you will get opportunities where you can buy an amazing home run of a deal, but it will come with a lot of risk. Something could go wrong. You don't want a portfolio full of those types of deals. You want to mix that in with some safer ones. So let's talk about how this works personally in my own ecosystem. I've got investment properties that I buy that sit at the top of a pyramid. The riskier ones are near the top. And then as you go down the period and the base gets wider, I have more deals that are less risky, and those kind of balance out the more risky ones. If I have a lot of properties that are guaranteed to cash flow and they're very safe, I can go after some of the bigger deals that might have a little more risk, that might have something go wrong, and they'll be supported by the ones that reliably and steadily cash flow. But even below that part of the triangle, I have a bigger base in this pyramid, and that is money that I make from other activities. This would be stuff like selling homes and earning a commission, or doing loans for people through the one brokerage, or maybe speaking engagement fees. Okay, so I get paid in these areas without nearly as much risk, and that supports some of the investments that I make because I have money and income coming in from that. But even then, that's not guaranteed. I don't know that money is going to keep coming in. The market could change. The agents on my team could leave. Something could go wrong. So then I want a base layer even wider that's underneath that. And that could be things like book sales. That could be things like side hustles. That could be opportunities like a mastermind that I run where the members pay, right? So I'm always looking at the higher I want to build, the deeper my foundation has to go. And this is how you scale safely. You don't put all your eggs in the same basket. So let's take short-term rentals, for example. Short-term rentals tend to be riskier with a higher profit margin. What happens to the person that has 20 short-term rentals in a red hot market and they look like they're crushing it? Money is just flowing in, and then something changes. The city votes and they say, no more short-term rentals in this market. What do you do with all that real estate? What do you do with all that debt service that you have to pay? What do you do when your whole business model implodes from one decision that you had no control over? That is a person that was operating at the top of the pyramid thinking that they didn't need a base. And what happens is they end up with an upside down pyramid. Okay. So the majority of their assets are risky. And when you have an upside down pyramid, it topples over very easy. And that's what I would recommend people avoid. When you're scaling, you have to have a consistent number of jabs for every uppercut you're going to throw. And if you do that the wise way, you'll be okay. Let's say you want to eat more food. Well, what if you don't want to get fat? Then you better exercise more, right? Exercising is the base of your pyramid. And then maybe some of the sweets that you want to eat go on the top. If you want to eat more sweets, you got to do more exercise. And that's the healthy way to scale. So not only do you want to not scale too quickly because you can make mistakes, but not scale too slowly because you leave money on the table. You want to make sure that you don't want to scale too unsafe, which would be buying only uppercut type properties. And you don't want to scale too safely because then you don't scale. If you just keep making the pyramid wider and wider and wider, but it never goes up, you end up not making that much money. So you kind of have to balance both sides. But if you think about, for every risky property that you buy 2 or 3 medium risk properties to support it. And for every one of those, you buy 8 to 10 very unrisky properties to support those. You see how you have a very healthy base that also allows you to scale up. Now, why do I love real estate? Because scaling is easier doing this than almost anything else. If you wanted to start a restaurant chain and you wanted to have 9 restaurant chains all throughout part of a state, that is incredibly difficult to manage. There's so many employees, there's so many moving pieces, there's so much training that has to be done. It's incredibly difficult to review the profit margins for every one of those restaurants and make sure that you're not being taken advantage of or that things are going well. One property manager can easily manage 9 properties and give you everything that you need to see every month in a 30-minute Zoom call. This is an asset class that scales very, very well. And that's one of the reasons that I love it. Now let's talk about some of the psychological reasons why people don't scale or they do scale too fast. In my experience, the people that scale too quickly are often doing it for reasons other than the fundamentals of real estate. So if somebody's trying to build a portfolio of cash flowing properties to take care of their family, that's a good motive. They're going to balance wanting to make money for their family with not wanting to lose everything the family has. But what if someone is motivated by insecurity? They want everyone around them to think they're a big deal. They don't think they're enough, and their identity is based on how many houses they buy. You often hear these people say, I have X amount of doors. Well, some of these people are not actually legit real estate investors. They're just limited partners in a syndication, or they're a part of 4 or 5 other partners and they have a share in that partnership, but it's not nearly as much as they talk about. Those people scare me. If you're motivated to scale because of emotional reasons or personal reasons, you're often going to have clouded vision and you're likely to make bad decisions. On the other end, you have the too safe Tommies, where every single thing they do, they have to think about what could go wrong. These are often the engineer mindsets. Engineers can't help but think about what could go wrong. And while that is good in their job, it's not always good in their investing. You could be like me and buy 1 house every year or 1 house every other year. And in 20 years, you'd have 20 houses. But if you scaled in 20 years, you'd probably have $100 million worth of real estate through several apartment buildings and really good individual residential houses in great areas. The people who scale too slow are often only thinking about what could go wrong and not thinking about where they could go, where things would be right. They lack vision. So by forcing yourself to have a vision and chase that vision, you will often make sure that you are scaling at the level you should be. Brandon Turner has a really good way of describing this. He calls it the stack. Now in the stack, Brandon says you should buy 1 house your first year, a duplex your second year, a fourplex the next year, an eightplex the next year. Every year you double the number of units you buy. Now, Brandon's theory, I think, is pretty solid. By doubling what you're doing, it forces you to grow. But at the same time, you're not growing so fast that you can't handle it. You can step up from 32 units to 64. And if you can handle 64 units, you can handle 128. That is absolutely true. And this forces you to scale, but it also puts a governor on trying to scale too fast. You don't want to go from one house to 100 units and from 100 units to 1,000 units. That would probably cause you to lose your portfolio. I'm hoping some of the ideas are really helping, as well as helping you see why I love real estate, because you can scale safely and also quickly. It's important that you understand that you can make a mistake in either direction. You could go too fast, you can go too slow. You can go too risky, you can go not risky enough. You gotta find that balance, but that's the fun part about this, is you have so many creative options for finding a way to scale a portfolio, make yourself into a multimillionaire in a very relatively safe and somewhat easy way. I think you can make millions in real estate easier than any other way to make millions. That does not mean it's easy to do, but it means it is easier than doing it in a different way. I really hope you've enjoyed this video, and I want to encourage you to ask yourself, how can I scale faster and how can I scale safer? If you enjoy this video, please subscribe so that you get notified the next time that I make one. And if you want to be around more people that think like this, please consider checking out my private mastermind. You can find out more at davidgreenmastermind.com, where you can get around other investors that are doing the same type of stuff and be taught personally by me how to scale your own portfolio. Thanks again for watching. Please consider checking out one of my other videos.